Welcome back to another video, and today we're talking about dollar cost averaging. So when the market dips, you should take advantage and use a strategy called dollar cost averaging. And that is simply buying stocks on a regular basis, no matter the price. And so we'll hop over on the charts and I'll show you and I'll tell you why this is important, and this is a good way to grow your wealth. All right. So we're over here on Yahoo Finance and we're talking about dollar cost averaging. So I already went through what the definition is, but let me just show you how you would use it. Like, this is one of my favorite stocks, Amazon. Currently have the 3-month chart pulled up, but let me show you the 5-year. So it's essentially been up and to the right for the past 5 years. You know, we had the dip in the 2020, we had like the 2020 COVID dip, and you know, we had other dips throughout the time period. You know, went down in 2022 where technology saw a big sell-off, but then we recovered. But at the end of the day, think about, even if you would have bought it during this down period when we had the big tech, the last tech crisis in 2022. You know, you got prices in the 110, 126, you know, 103 in the 90s and 80s. Just think about if you just continue to bought this stock along this time period, and look at where we are now. Even as red as it's been with all the talks of tariffs and DeepSeek and all these things that causing the market to go up and down, look at where we are. We're at 207. And if you would have been buying back in 2022, 2023, like, you would have got this stock in the 80s. So that's why it's so important to just buy no matter the time period. Just keep buying. If it's something that's of good quality and they make consistent revenue and they make profits that guide higher during their forecast, like, don't be afraid to buy. Don't be afraid to buy. But let's look at the SPY. We're over here looking at the SPY. So this is the S&P 500, or this fund tracks the S&P 500, and so it tracks the top 500 companies in America. And when people say the market, this is what they're referring to. And currently we've been in a little bit of a downtrend, you know, the past couple months. It's been a lot of different things. This new administration, they're headline heavy, I put it that way. You know, there's always something that they're involved in and something that's going on that's going to move the market. And so recently we've been dealing with tariff talks, and we've been kind of dealing with inflation, and like people been bringing up the term stagflation, which is a topic for a whole nother video. But there's been a multitude of reasons why the market just hadn't been going up and to the right. But the focus on this video is dollar cost averaging. We are getting a gift. We're getting a gift, I will tell you that. So anytime the market's down, like, you should be buying. Don't look at it like, oh, I'm losing money. No, these high quality assets are on sale. You need to look at it that way. Like, if you were buying Amazon up at 240 and you liked it, I don't even know, I think, yeah, it was at 240 at one point in time. If you liked it at 240, why would you not like it right now at 208, 209, or wherever it's trading at right now? But yeah, so I just want to introduce you guys to the topic of dollar cost averaging. And so, for example, say you bought a stock at 250, then you know, it dropped down on you, and then you bought another share at 200, your average cost is going to look like you bought it at 225. So that's one thing. It can lower your cost basis when you're investing. And you should have some sort of investment plan, whether you're buying weekly. I like to buy weekly, you know, bi-weekly or monthly. You need to get on some sort of plan where you're automating your investments, or at least automating your deposits. But, you know, to each his own. I'm just trying to help y'all make money around here. So in conclusion, dollar cost averaging can help you build a strong and solid portfolio. So we should be investing for the long term. So we should be looking into companies that we're willing to hold for the next 5 to 10 years. If I bought Meta stock, for example, at 690 and it went down to 680, the next week, who cares when I think the stock is going to go to 2,000 within the next 2 years? So this is just a quick example. Hope you enjoyed the video. And if you made it to the end, please like, subscribe, and leave a comment on something or a topic that you want me to cover in the future. And until the next time.